Good evening to all of you. Welcome you to today's webinar. Today we are going to see Fibonacci system, its applications in equity indices as well as in some stocks. Now, we have had many webinars before on Fibonacci system, but today we are trying to give a different angle to the way that we can use Fibonacci to trade and also for investment. You know that the investment opportunities in Nifty and Bank Nifty and some other asset markets, we have already highlighted the normal performance in Nifty. Generally speaking, Nifty gives a return which could be anything between the CAGR could be 11 to 15% per annum. So this is what we have seen last week. Generally speaking, between if it's 1 year to 5 years, sometimes the base, 1 year there could be some up and downs. But over a period of 3 years, 5 years, generally we get a return which could be 12 to 14% per annum. Now, most of them are looking at, okay, this is fine as far as investment is concerned, whether we do it in bulk or through SIP or identifying some important levels to do that. But most important is that we are trying to look at whether we can add a couple of percentage of points without being too dynamic. So there are different aspects for investment. One is a very, very passive investment where you don't look at levels or something like that. You just keep on investing probably on a time period. That is, every month you invest on a particular date. So that's something like a time-bound SIP scheme. Continue. Okay. So we are looking at the appetite to increase the return without being too dynamic, because the return means different things for different people. Some people will be looking at a little more dynamic type of investment where probably you look at on a weekly basis, or you look at a monthly basis to turn around portfolios, or on a quarterly basis to turn around portfolio, depending on the movement. So whatever that is comfortable according to your time and resources, you can look at that aspect, because trading and investment is both an art and science. While we listen, learn and try to implement certain things, there are certain things which probably will be different for different people, like the investment time horizon, and also you're choosing a time frame for your investment as well as for trading purposes. So that I leave it to you, but I will outline the general principles for both investment as well as far as the trading methodologies are concerned. So it could be useful whether you're going to do a very short-term swing trading or you're going to do a long-term positioning, where you normally look at very simple concepts like what are the simple concepts? Fundamentally, you looked at certain concepts like PE ratio, EPS, what is a trailing PE, and normally at what level it takes it up support, to what level it can go up. This we have seen. So what we are trying to do is, we are trying as far as possible to gel the fundamental with the technical factors for investment. For trading, we are purely going based on certain sort of system, which could be a moving average or Fibonacci, or some important high lows being cut. So all those things. Now, let us look at split it in two. One is the investment, then investment combined with trading, and then trading. Now, we have seen that Nifty, for investment purposes, we have seen that it is better to invest when you get a trailing PE of 20, because in the last couple of years it doesn't go much below 20. Now, the estimated EPS for March quarter for the year end is around 830. That is for the financial year end. So we have said that 830 into 20, 16,606 approximately. The market has very low probability of going below this, but even if it goes below this, there could be a decent rally which will take it at least minimum of 10% from this, because right now itself the EPS, the PE is trading at 22. It bounces from 20 to even 24 or 25 at some stage. So let us look at even a 10% expansion back in the PE. So when you invest in this particular level, you definitely get a chance of getting at least a 10% return per annum, which is what now you're looking towards beating the market, beating the FD rate of interest. So this is a good level of 16,600 for you to look at the investment. But as the quarters progress, you know that you get a new set of numbers. What is the problem? One minute, sorry for the disturbance because of certain technical reasons. We couldn't continue as we wished. Now we will continue with this. So we know that 16,600 as things stand, depending on the EPS, which is estimated thing, market has a very low probability of going below 16,600, right? But as the quarters come through, we get more data, particularly the earnings season. You get company results, and due to that, the EPS keeps moving up, right? So there is always a growth in EBITDA, and that is almost you have a upward movement in the EPS. So because of this, the 16,600 which you are projecting now itself can become a slightly higher as the months progress, as quarters progress. So what we are looking is this is a worst come scenario. Now let us say market is now at 17,800 approximately, 17,800. So let us look at which levels it will go, which can be slightly above the 16,600, because 16,600 is the most important base case scenario which you are talking. So how do we look at this? Now we need one more trading tool, one or two trading tools, along with the fundamental factors, to identify the important level at which we can go for an investment, which will also take us to some higher levels again. So let us look at Fibonacci as one of the important. See, we have got Fibonacci, we have got maybe moving average, trend lines. Let us say these are three important tools which are generally used by traders. Today we will look at Fibonacci. Sometimes what we need to do is we need to combine one or two systems, because they are simple systems. So one or two systems in order to get a finer point for buying. Okay. Now today we'll look at the Fibonacci in a very simple way. Now we have already said that Fibonacci numbers, you got 1, 2, 3, 5, 8, 13, 21, 34, 55, like that. It keeps on going. And higher levels, because Nifty is trading at around the 18,000 mark, so you need a definitely higher Fibonacci level. So if you do this, then becomes 89, then 144. You add two numbers, consecutive numbers, you get all this. So 233, then you get 377, then 610, 987, then 1597, right? 1597, then almost 1,000 points here, 2597. So 2597 means 2584, I think. Get 13. So these are all the important Fibonacci numbers which we can use it for Nifty. So how do you use this? Now we have to identify some important low and important top. So that's also what we are doing is we are not looking at any big complex things. We just know what the numbers are. probably we also should now we are familiar with the ratios, which is 23.5%, 38.2%. 50 is not a Fibonacci number, but a lot of traders use it. 61.8% and 76.5%. So the last important support is around the 76.5, but mostly it will not come much below 61.8, or at the maximum it will come anywhere between 61.8 and 76.5%. Normally it doesn't go much below 76.5%. So this on the ratio scale you use it. On the number scale is what we have seen. So whichever is comfortable for you, you can use it. But what we need to do is that we need to identify some important levels from where the market has gone up. So we can probably use those who are looking at from the investment angle, we can use a monthly pivot. What is the last monthly important pivot low? Okay, from there we can make a projection for the next important support. So we'll go to the chart now. See, this is a monthly chart, Nifty. Monthly Nifty chart. The last important low is this. Okay, so 16,747. 16,747 is the last important low. So we will analyze, and also 18,887. 18,887. 16,747. Right. So these are the this is the important high and this is the important low. Okay. So we have the Fibonacci numbers. No, we have got the 610. I told you 987, then 1597. Right. So if you add these two, it comes to 1597. So 16,747. With this, you keep adding these numbers. Okay. So 16,747 plus 987, approximately, let us say 1000. Okay. So this comes to 17,730 or so, whatever it is. So I'm not just rounded that. So this is on in a figurative basis. When the market is falling, you could have easily said, without being a great market analyst, just using the Fibonacci number, this one you add with the important Fibonacci number, which is 987. Okay. So once it starts to come closer to the 987, because it has to fall below 987, 610, and then keep going down to lower numbers. So now this is the rally is from 16,747. It has gone up to 18,887, which is approximately 2,100 points. Now from the basis of a Fibonacci number, we have already identified 987. Okay. Suppose if it is going to fall further, 16,747 plus 610. Okay, this comes to 17,357. So approximately you can say this is the level where probably we have taken the first important support. Let us look at the chart. Monthly chart, 17,774. Right. So this is where we identified very important to be an important support level. Now the next one, if it starts to go down, we have said that 17,357. So this could be the important low. This could be the next important low. Now we will use the same methodology, that is the ratio methodology, to understand to what extent it will come down. Now before that, let's look at the Fibonacci in terms of a trend change. Now normally you go with the important concept of a trend, right? Because you would like to go along with the trend in order to make money. Now we have seen on the monthly scale, the market is on the upside because you got higher highs and higher lows, because the last important two highs, that is the 18,887, is above the previous important monthly pivot high. We have already got a low which is 16,747, and below that there was a low of 15,183. So we have got two important higher lows and also two important higher tops. So that means our basic expectation is 16,747 will not be broken. Now when will that trend change? Normally, as I told you, it is a 61.8% or 76.5%. That means 18,880, let us say, 16,747. This is approximately 2,100 points, right? 2,140 points, let us say. For 2140, let us do a 61.8% retracement or 61.8 retracement of this particular value. So what is 61.8% of retracement? It is 2140 into 61.618. It is 1,322 points of retracement from this level. 1,322 points. So of retracement from this. So 18,880 minus 1,322, 17,558. So this itself is going to be a very important support. So if the market breaks down below the 17,775 or so, then we will have very good support coming closer to 17,558. The worst could be 0.765, 0.618, 2140 into 0.765 retracement. It's very unlikely to go much below this. That comes to 2140 into 0.765. This 1,637. 1,637 points of retracement from 18,880 minus 1,637. Okay, so it is 17,243. Now earlier we have seen 17,350 using the Fibonacci number, and this comes to 17,243. That's 76.5. I told you the worst is it could stop between 76.5 and 61.8 also. So anywhere between 17,250 to 17,550, I think we need to keep that for investment. So if it starts going below 17,550, right down up to 17,250, it is better to buy, because even at 17,500, let us say, divided by 830p EPS, which is estimated, you are getting it close to 21 PE, and sufficiently we may have a decent chance of getting a 10% up move from that level. From that level, we may have a sufficiently decent point to move up. Now, having said this, how do you increase your profits? Now, let us say you are able, you are buying closer to the 17,500, 550 levels. Okay, so where do you, how do you, take profits? Okay, one, it could be based on the PE into estimated EPS. Now, when it came to 18,880 right now, so we have divided by the 830 EPS, it comes to 22.74, 23. So that means whenever the PE goes closer to the 23 or 24, let us say 24, I think that's the time, if you've seen, most of the time there will be some profit taking closer to the 24 PE. So this time, if it is going to be 830, now of course next year it will be much higher, 950 or so also can come. So we have to look at if suppose if it goes to next year, say 950 next year, 1 year you are waiting for it, and if EPS goes to 950, so at some stage other we will have 950 into 23, which is 21,850. Next year somewhere it's a good possibility that we can get this, and the base case scenario itself could be 950 into something like 21, which could be for doing 1 year from now, I'm saying it could be 20,000. So if you're buying now at 17,500 levels, so you're assured of around 2,000 points almost, which is almost 11%. If it goes up to this, then further it comes to 15-16%. So this is where probably you look for any weakness that could come in the market, take your profit, then wait for something down, and then look for investment. See, the confidence that we have already given last week is that 18 out of 22 years, the market fall, the market closes above the previous year high. This year, the high is 18,000. 105, right? So any dip below this, if it even goes up 4 to 5% from this, and you are buying closer to the another 3% down, here itself you are assured of something like 8%. So 3% down, you are buying at 17,500, and even if it closes at 4 to 5% above 18,105, you are sure of getting 8% or more. And 1 year later, so because of tax and other benefit, you are definitely going to beat the FD. Only thing is how you are going to increase it. Now, let us say in this year itself, let us say in this year itself, you invested some time back and market came to 18,880. Okay, so how do you take the profits? Whether you are going to take the profits based on the fundamental factor of the PE going to 22 or 23, that is left to you if you have got a decent return already on the investment, or you are going to look at a combination of that with a technical factor on how do you enter the market again and again. So suppose if you are going to do that, then in that case you need to take the profits quite early before, because the market fall generally, if it is going to be a bull market, we don't expect now the fall to be more than 9%. We don't expect the fall to be more than 9%. Now we have seen in this also the bull market. See, now this is 18,096 to 16,747. 18,096 to 16,747. Okay, now minus 16,747 divided by 18,096, right? This itself only 7.5%. This fall is only 7.5%. So normal market could go down anything between 5.5% to 7.5%. Normal thing is 5.5% to 9%. Any bull market, normal corrections are anything between 5.5% to 9%. Suppose if you go with the 5.5%, already 1,000 points, it has already come down. Okay. Now, if you are looking at the same percentage factor of 18,096 to 16,747, the same 7.5%, now 18,880 into 7.5%, it is 1,416 points or 1,400 points. So 18,880 minus 1,400 points, it should put us 17,480. That is what I'm saying, 17,500. So the 7.5% fall could take it down right up to 17,480 to 17,500, where a good support you can expect. Suppose if it goes down a little bit down also, another 1.5% which I told you, which means another 200 points or 250 points, which is 17,230. So 17,230 is going to be a very, very important level, below which I think if it is a bull market is not going to break. But you don't need to wait till then. So an investment should start closer to the 17,480, and then you will see a good amount of return over a period of 1 year, 3 years and 5 years, because the low from the investment from the low level will always give you a profit, will always give you a very good profit. Now the only thing that we can do is, okay, because we are investing at 17,400 to 17,200, we can put a tail end stop loss which is below 17,000. Normally it should not go, so you can put an option closer to 17,000 in order to make a decent this one, that is, you can just pay very less premium. Probably you can do on a weekly basis or so also, because if the run has already taken place, then you don't need to bother about it. In any particular week, if it is going to fall much lower, then you have got some safety factor. So to that extent, you can go for an out of the money put option in case if you are a little bit afraid. But if you are going to be an investor, you can just do that. So these levels are now supported from 2-3 ways. One, we have talked about the likely EPSP fundamental point of view. We have already talked about it. We have also supported with the pattern of correction. Last normal pattern of correction exists for 5.5%, and last time instead of going right down up to 9%, it just stopped at around 7.5%, because now big bull markets, normally the corrections are anything between 5.5 to 9%. If in India, let us say we are already in a bull market, because it broke the 18,600, that means we should consider this as a correction. So any fall which is below the 17,750 should probably should not take it much below 17,230. Should not take it much below 17,230, and it can even stop at 17,550, and that has been supported with a Fibonacci ratio which is 61.8% retracement from important monthly pivot low to the present high of 18,880 levels. So anything between 61.8 to 76.5% can stop this. So now, for those who are willing to invest blindly at these levels, fine. But some the traders would be looking at a slightly different methodology. Now we have talked about the investment point of view as to where the Nifty can be invested. The same thing can apply for Bank Nifty also. We will show that, and then we can see how the Fibonacci can be used for in the case of trading purposes also. So now let us look at first at the Bank Nifty, then we will look at the trading call. So Bank Nifty, no, we can either look at this low. From this low, we can look at what is the important Fibonacci support resistance. The reason being is that normally it doesn't go much below a 3-month thing low. So I think right now this is 1, 2, and I think if this month if it does not go much below this, then we expect that even that 40,800 itself can hold, because normally we don't see markets going down much below a 3-month low. Normally it doesn't go much below a 3-month low. This is the pattern if you see in 2000. See here, once it started to rise the post pandemic, we have not seen only this time there was a correction, right? So this time it broke, and after that it took some time to break a 3-month high, and this was the 3-month high. Okay, this was the 3-month high. So now if going by the same basis, right now for this month 3-month low, because this is this month, so 1, 2, 3, this is the low, this is the 37,963 is the low. But next, suppose in this month, in January, it does not break much below 40,819, and in that case we may get a support closer to 40,820 itself. We may get a support which is very closer to the 40,820 itself. Nevertheless, we will look at the Fibonacci level for this. So we have a support. The 23.5% retracement is 41,343. 38.2% retracement is 39,621. Now, this we are speaking from this particular low. That is the most important last time low that we got. So the first important support itself will come closer to 38.2% retracement. Normally, if you see, the most important supports come closer to 38.2% retracement of the from the top to bottom. Okay, from top to bottom or bottom to top, 38.2% retracement is the most critical thing. Then after that, there is a chance it can fall right up to 61.8%. Now in this case, even 38.2% retracement from this particular level can only take it up to 39,620. So 39,000, only if it breaks 39,620, we can probably say that this trend from here to this place is over. Till such time it doesn't break a 38.2% retracement, I think we can say that it is still bullish. So on a monthly basis, the 39,620 is a very important place. Now we will do the same Fibonacci from a different place now. That is 23.5%. Let us say from this level. So that comes to 37,390. That comes closer to 37,390, and I don't think so. No, we should be looking at that. So that's the worst case scenario. That is 37,390, which is approximately 7,000 points from here, which is more than 15%. So probably only in a worst situation, I think suddenly there can be a fall towards 37,390. Otherwise, we can expect that probably the earlier one which we showed around 39,000 itself can hold, which is a 38.2% retracement. So this is a simple way of organizing the call for investment places. along with the fundamental factors. Another important thing which we want to highlight before we go for the trading call. Normally this happens more with stocks, but even in Nifty it can happen. Generally, the broad index, particularly the Nifty, okay, it doesn't go down much below, I would say, 20% to 23.5% from the peak. Only 2 or 3 cases in the entire 15 years since 2008 it has gone down. One is the Lehman collapse of 2008. Then we had the retrospective taxation 2011, where it went down by around 25%. Then 2016 there was a drop. There's also approximately there's 25%. Then of course the pandemic time when it went down by 38% or so. This is the time when there was a drop of more than 50%. So generally speaking, okay, these are all extremely global crisis, okay, extremely unforeseen global crisis, and let us forget this. I think then in that case we will never be able to do any proper trading. So normally we can keep these two, that is the 25%, but generally 25% you don't need to. This is the bracket. This is 22, 23, 23.5%. Is a normal major correction, and that also fits in the Fibonacci, that is 23.5% of the peak. Generally speaking, Nifty, though it goes down in 1 or 2 circumstances, the bull market falls are normally corrected within 5.5% to 9%. In a bull market, the corrections are only up to 5.5% to 9%. In a slightly deeper correction, it can go anything between 14 to 17%. The deeper correction, it goes right up to between 14 to 17%. Okay. So, what probably we can look at it is, these are, so what is a bull market? Now in the bull market generally it is above 200-day moving average and above 50 and 200 moving average. 200-day moving average, normally they call this a bull market. So if the Nifty is above that, above the 200-day moving average, then in that case we can say that a fall up to 9% is where probably looks to be a place where we have to take the call and move. Otherwise we will be left out. So suppose if it goes down from 9 between this level, it becomes an additional place where you can do some lump sum investment. Okay, you don't need to get deterred. So you will get between 9 and 14 and to 17%. Then in that case you will be still down, will be picking it up around 12% from the top, which means when the market rises back to that level, you get a 12% plus something there. So you will definitely get a good amount of return on investment. Now we are only looking at most important thing is we are trying to look at some sort of a churning, okay, where churning means how to increase the return, Now we will look at the Nifty, we look at the daily chart. Yeah, I told you just now that any important low or high, see this is a low, this is a high, right? So the definition of low and high we have seen many times. Now let us say you are in a uptrend in a daily chart. That means you are getting higher highs and higher lows. Okay, it is coming like this. Okay, higher highs and higher lows. When that happens, the retracement of the last low to the present high, the retracement should not go below 76.5% retracement. Retracement should not exceed 76.5%. Normally it can stop anywhere between 61.8 and 76.5%. So when you are doing an investment, okay, I told you from the fundamental point, it's very difficult to exit unless you are satisfied with some return on investment, and then you know that it is. For example, let us say the PE goes to 24. It may look very heated up, so you may try to chop off, go back to cash at 24 level. But sometimes we can see the 24 also going to 28 also. So it could be quite frustrating. So what you need to do is that though you have certain apprehensions about the extended rally, you would also like to ensure that you don't miss out that extra return that you get, but at the same time exercising caution. Okay. So what do you then do? So then you try to apply your trailing stop losses at 76.5% retracement of an important daily pivot to daily low. Okay, so that you can get an exit at the earliest stage. Now let us say what it means here through charts. Okay, so this is the daily chart. Now what I mean by this is, let us say either you take this as an important low, or you can take this as a low. Okay, whichever one you feel is to be taken, you can take. Let us say I am taking this particular low. Okay, low. Now I told you that normally you will have something between 61.5 and 61.8 and 78.6. Okay, that's the normal retracement you normally get. Okay, and so this is the low. This is the place where probably you need a cut below this. You need to go take off your stop losses for any investment that you have done also. That is 18,345. Well, you are losing 500 points from the top, almost 2% or even 3% you may lose. But now you are going to do the investment back at 17,550 or so. That means you are still getting some gap. You are still getting a gap because you are taking it off at 18,350 and you are going to invest at 17,550. That means around 800 points you have saved, right? About 800 points you have saved again, which probably could be very helpful. And at the maximum, even if you're when the market scales back, then in that case you have taken a profit at 18,350 and then you have invested back at 17,550, which means your return on investment can get enhanced. So the alternate thing is that if you have taken this particular low, then in that case you let us say so you would have made an exit somewhere here. Okay, you would have made an exit somewhere here because this is a low between the 61.8 and 78.6. So this place is the place where probably you would have made an exit, right? That is 18,525. So 18,525 you would have made an exit, and you will probably looking towards a re-entry. Now, well, let us look at. I told you that is a pivot. This is a pivot high. Okay. This is the pivot low. Okay. Now let's draw the Fibonacci from here to this. See, again it has stopped between 61.8 and 78.6. It did not cross 78.6, but slightly went above the 61.8% retracement. So this is the now if we, assuming we are not getting anything further low, let us say markets are not going down as we expected, because we are expecting a fall which could be, see, this is a 200-day moving average, right? So this is a 200-day moving average, and the 200-day moving average is coming closer to 17,266. So let us say the market does not fall much from here, and it still suddenly it reverses and goes back. So what is that we should be alerted? That is above which level we should be looking towards buying again. Now that level is this. That is above 17,000, above 18,265. The reason being above 18,265 is that from the last important pivot high to the important pivot low, it has just stagnated at this particular level. Now, as we go down, as we progress lower, then probably we'll be taking the Fibonacci from this level to this level. That is from this 18,265 level to whatever that we get on the downside. Okay, so that will become the place where probably we'll draw the Fibonacci and look at a retracement between 61.8 and 78.6, and if it starts to take off from that level, then we will be looking towards the re-entry. So at this place of time, we are now looking at something down, and which is could be 17,550 levels, 17,500, 550, and the worst could be something like 17,240, 250 based on the Fibonacci on a monthly pivot. And at the same time, right now on a daily chart, it is down unless it crosses above 18,265 at the present juncture. So those who are looking for investment, if you don't get a drop as we project towards 17,500 to 17,250, if there is a reversal above 18,265, you should enter. Then above 18,265, when you enter, you put in your Fibonacci between the last low, which probably do not know what is the exact low, but let us say this is going to be the low, 17,935, 17,925. The moment it crosses 18,265 to whatever high that keeps going, put in a 16.8 to 76.5, and if it starts to drop below that, then you can go for a buy. So the early entries you will definitely get, and with a slightly good stop loss also. So this we can combine. That's why now the investment is being combined with a trading position also using a Fibonacci. Now let us say look at the Bank Nifty. Bank Nifty also we have the in Bank Nifty. Okay, so this there's no proper close, so we are taking from this level only. See, here it stopped again between 61.8 and 78.6. Just went very close to the 78.6%, and it has fallen, right? So now we are looking at some sort of a fall if it happens, and in that case we will be looking for the Fibonacci from this level down to whatever level that we get, and the 61.8 to 78.6, when it is cut, then we will definitely look towards going for a long position. Okay. Sometimes what happens is that we may have a high low very uncomfortable, like for example here this place, if you're looking at a 61.8% to 78.6% of this retracement, then it will come very closer to this, right? It is coming here. Okay, it is coming closer to this place. So only above this you will go for a long. Only above this you will go for a long. But even then, if you have gone for that, probably still it's okay, because whatever you did here, you will be closing somewhere here. Okay, you will be closing somewhere here. Okay, and then waiting for a reinvestment. You will still make a profit, and through this, doing any big meltdown, probably your investment will not be there, and you can pick it up at some much lower level, which will give you the profits by doing this. So once you get once in a year or so, when there is a bigger fall, you would have knocked off your investment early by doing a trading system, which could be based on Fibonacci or whatever it is. Then in that case, you will be just holding back, looking at re-entry based on your trading principle, and the investment also you will be keeping in high at some low level, and once it starts to bounce from that, then you will definitely be looking for investment back. Now some other principles which we have already talked about, and which will again look at it, is there are certain amount of ups and downs above which the market starts to rally. Now for example, in recent periods, Nifty generally you have let us say this is 17,774, this is 18,265. It is 470 points, 460 or 470 points, 18,265 minus 17,774, right? So 490, 17,774, around, I think, yeah, so 490 to 500 points. If you see in many cases that 500 points, see for example this move, which is 18,887, this is 18,345. It's approximately a 500 points move. So a 500 points move here, and let's look at this place also. So see here this correction, 17,428 to 16,950. Again that 500 points move, and here you see after a fall 17,429 to 919, again that 490 points. So somewhere this 490 to 500 points is where probably it is proving to be a trend change presently in Nifty. Now let us say this here if you look at it from this place, uh, after a fall, which is 17,345, 17,725, which is approximately that 400 less than approximately 400 points. Once it started to rally, if you see 17,777, 17,468 is even only 300 points. So normally right now we are looking at something like 490 to 500 points, which then becomes a 1000 points. After that it becomes 1000 points, then it becomes 1500 points. So somewhere there seems to be some multiples of that 500 points which is happening. So this is a this is a pattern which we are right now seeing, and here also once it started to turn bullish, if you look at it, 15,927, 15,511. So again 460, 470 points. So you can look at some sort of a trading where probably you can just say if it's going to fall below 500 points, I will take the profits, and once a bottom is formed and if it starts to rally 500 points above, we will go for a long position. So that also you can do. Say once it started goes to rally above 18,265, now maybe you can wait for a drop of under 200 points and then probably put in a stop loss of 200, 300 points lower also. Or if it starts to rally above 18,265, you can buy, keep a stop loss below 17,800 in the form of an option, and look towards taking good amount of profit at some higher levels. So somewhere you can cultivate this methodology of trading. So now what I told you is that is whatever that is applicable for the position trading is equally applicable as far as the intraday trading is concerned, which we'll look at in the coming webinar. That is on Thursday. We will look at some finer points of how it can be used even in intraday trading. So probably now we are talking from a big fundamental positioning to normal position trading based on the Fibonacci, and then we will look at the Fibonacci probably even in the intraday trading. Then we will also look at certain Fibonacci thing in the case of stocks, because stocks normally can fall much more than index if there is a bigger correction. Now if index corrects by 10%, lot of stocks, because high beta stocks can correct by more than 20-25%, and once the stocks corrects by more than 23-24%, then in that case whenever it starts to rally from its from any particular bottom, when it moves up, it will have the resistance based on the same 23.5%, which will highlight how it is. So there are big stocks which will not cyclically good earnings, good dividend paying, all those things. For example, TCS, Reliance. Normally, these stocks rest at not more than 25% from its peak. Generally speaking, it is around because that is normally a PE correction which takes place. The rest of the things have been taken care of, let us say, by EBITDA or so. So we expect that 25% maximum, around 20-25% of correction. That we will highlight in stocks like Reliance, TCS and all. And what happens if the stocks goes down by more than 25%, then where do we pick up again? So which are the stocks which are looking good based on that? For example, suddenly we have seen Tata Steel. Tata Steel doing well. So the metal index itself has started to do well. And that can be identified later on. You may know what are the fundamental reasons. But we can identify itself with an important Fibonacci ratio. So we will use these concepts and look at various angles to ease our approach towards trading, and also to take calls, and for both for investment as well as position trading with great confidence. So now time is 7:50. So you can ask your questions now. Thank you very much. Trend following time frame intraday. See, intraday, normally what we do is we look at the hourly chart, we look at the 30 minutes chart. Now, I will on Thursday we have a webinar. Please attend on that. I will tell you some simple concepts as far as intraday trading is concerned, which could be just based on patterns, which could be just based on a pattern. Okay, two, three techniques. I will tell you. You can just follow that. Any trading system will have its own pitfalls. So what you can do is that you can come out of that in the intraday itself. For one example, I'll tell you, and then you can just work on that in the next 2 days. On Thursday when we meet, I'll explain to you. Now let us look at 30 minutes chart. So this is the Nifty 30 minutes chart, right? So we are not looking, okay, basically we are not looking at the 200-day moving average. I'll leave it there. Now, what we normally do is, say, let us say any 30 minutes bar, if it is broken on the lower side, okay, you can go short. Any 30 minutes bar broken on the upside, you can go long, generally speaking. But within that, whether you should go short or long can be defined by a trend. Okay. Now, what is that particular trend, which I'll tell you. Based on that, whether we should go long or short. But let us say today itself, 30 minutes bar. Today this is the open. So last 3 minutes, one is, this is the first hour. This is the last one of the last yesterday's bar. So once it opened and started to close below this, which is the 18,032. So the first 30 minutes bar closed below 18,032. It closed at around 18,018 or so. You can go short. But the stop loss will come at 18,127. So because of the high volatility, the stop loss came closer to 18,127. Now, towards the end of the day, you could have just kept on this because there was no 30 minutes bar being broken. End of the day, it broke this particular high, which is 17,918. So you could have got down, you could have sold at 18,032, and you could have come out of this by 17,918. Don't buy exactly 17,000 because it is at the last bar, almost 30 minutes. We don't need to trade that. Now similarly, we could have seen the previous day also, that is on 6th January. 30 minutes bar has been broken. Now here generally the trend is down. I'll tell you why, on what basis we are picking the trend. They're slightly different from the moving average. But let us say this is the 30 minutes trend being broken. Okay, then in that case this is also a low, which is 17,953. Then at the end of the day, you could have closed at 17,881. Okay. Now here it opened higher, so I'm not very sure whether you will be comfortable in buying right now at this place. If you buy, then I just 18. You will be buying closer to 18,000, and you'll be putting a stop loss at 17,827, which is too big. So probably if you're not comfortable, you can leave that because of the huge stop losses. Now after that, during the day, you've got a 30 minutes bar being broken here, 18,082, right? After that, it came down, and then it started to break about this 18,077. So you could have got without loss or profit. Now 18,077, we have got another 1 hour left. So 18,077 you buy, and probably closes 18,088. So you would not have lost money. You could have got out of it. So we will look at this particular system along with Fibonacci on Thursday. Okay, thank you very much. Bye. So thanks for your participation today. So we'll see you on Thursday again.